This is the CRE Weekly Digest by Lightbox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Melissa Lewis with our expert Manus Clancy. This week, we're excited to welcome Richard Hill, Global Head of Real Estate Strategy and Research for Principal Asset Management. Richard has more than 20 years of commercial real estate experience across a variety of roles. At Principal, Richard works on capital allocation strategies while also leading the real estate global research team and is responsible for delivering the firm's ongoing economic and real estate views to clients. Prior to his current role, Richard was the head of real estate strategy and research at Cohen & Steers, where he was responsible for identifying allocation opportunities in both listed and private real estate and related thematic and strategic research. Previously, he was a managing director and head of commercial real estate research at Morgan Stanley, where he was responsible for public REIT equity research, CRE debt strategy, and macro property research.
Richard, we're going to start with a layup for you. We do this with a lot of our guests, sometimes in the beginning, sometimes at the end. But at one time in your life, you were an 18-year-old freshman, maybe hoping your team would go to the Final Four. And 10 years later, you're in the CRE markets covering REITs, CMBS, CRE. Tell us how you got there.
I actually grew up in a real estate family. My dad was a mall manager. I like to tell people that means he managed malls for people that own malls. That does not mean my family owned malls. I grew up in malls up and down the East Coast. Date myself here a little bit, but I remember being in mall food courts in the 1980s with jazzercise going on. No one remembers what jazzercise is, Google that or YouTube it. It's pretty funny. So I had no desire to get back into real estate, but fortune moved my way. And out of undergrad, I joined an interest rate derivatives desk covering commercial real estate developers and home builders. I did that for 3 years, moved over to the debt capital markets team at B of A, ultimately recreated myself as a research analyst, first on the debt side of the business, covering commercial mortgage-backed securities, then moved over to the REIT equity side of the business, and more recently, private equity real estate. I like to tell people that means that I've had quite a wandering, but hopefully a little bit of an intentional path across commercial real estate over the past, almost 25 years now.
That's a great introduction, and I want to revisit that later. At the end, we'll revisit your life running around malls on the East Coast, because that sounds like it's full of stories there. But I want to start with the market itself. I love reading your commentary on LinkedIn. Some of it is stuff that you post professionally from Principal or previously from Cohen & Steers. Sometimes it's reactions to other people's research. And I find you to be the voice of reason in the market, that narratives sometimes take shape. Sometimes players get panicked. They believe the market is the end of the world or the narrative is the end of the world. And you usually come loaded with data to kind of take the other side of the coin. So I want to go through some of those narratives that are kind of persistent right now and get your perspective on these. One that's been around for about 2 years is the wall of maturities. We've talked about this, that so much debt was piling up starting in late 2023. It was going to be the end of the market. We were going to see a second great financial crisis. Banks would see big losses. CMBS would see big losses. Help me put that in perspective.
Yeah, well, first of all, I appreciate you calling me the voice of reason. My wife says I need an intervention, but I prefer your interpretation of my involvement on LinkedIn. So look, the wall of maturities gets a ton of attention. And frankly, I've been in the industry for a long time. You can look up research reports from me where at one point in my career talked about, the sky is falling and wall of maturities being a really big deal, especially in the 2017 environment. I don't think the market fully appreciates the totality, first of all, of how big the commercial real estate debt markets are. There's a stat being thrown around, and it came about, and I know where it came about, and we're happy to discuss that if you want, that banks, and particularly small banks, have 70% of total market share for CRE mortgages. That's not true. Small banks have 70% market share of bank holdings, but banks are only around 40% of the market. So there's a misinterpretation here. To your point about wall of maturities, what we've seen happen is not, this end of the world sky is falling. I like to point to a stat that Alan Todd at B of A uses a lot. If you look at 2025 maturities, of the loans that were scheduled to mature in 2025, 75% of them paid off at or before their maturity date. That's a remarkable statistic. And by the way, if you exclude office, which was probably closer to 40%, the payoff rate was actually higher than the historical average. So what we're seeing happen here is not the wall of maturities being broken down brick by brick. It's that a lot more loans are refinancing than what people are expecting. Why is that the case? Well, not every loan maturing has a refinancing problem. If you had a loan that you took out in 2014, 2015, 2016, you actually might still be in the money on that loan. You actually might be able to do a cash out refinance because of the amount of property appreciation we've seen over the past 10 years. So that's point number one. Point number two is that there are banks modifying and extending loans. I don't want to beat around that bush. But there's another point here that was not prevalent, almost 20 years ago during the Great Financial Crisis, which is the abundance of CRE debt funds. So as I speak to various different lenders right now, what I'm hearing is banks are competing against themselves to keep the loans they want to keep on their balance sheet. Competitive pressures are almost as pronounced as I've ever seen them. Now, there's some loans that banks don't want to keep on their balance sheet. That's where CRE debt funds come in. Bottom line, the debt markets are really open and liquid right now. And so, yes, it's not puppy dogs and rainbows out there, but it's a lot healthier than what the market expects. So I'm going to pause there, but I also want to talk to you a little bit, and maybe where this is going next, about how cycles play out and if debt is a leading indicator or a lagging indicator.
I do want to get into that next, but I certainly want to get back into the question of how liquid this period is. I want to get your opinion later about whether or not this liquidity can lead to a lack of discipline down the road, but we'll talk about that later. It does segue perfectly into my second question, which is another piece of data that you have referred to frequently, or maybe it's opinion is a better word for it, that delinquency levels, special servicing levels, distress levels are lagging indicators. And almost right on cue this morning on CNBC, the headline was CRE delinquencies hit another all-time high, or 17 basis points up, or something like that. So the timing is exquisite. But talk about that. You talk about the fact that we're still on the upward trajectory in terms of distress numbers, yet that's not really representative of the market we live in.
Here's the way we think cycles play out. And when I say think, everything that I talk about is grounded in data. The way we think cycles play out is listed REITs trough first. Listed REITs in the United States troughed in October of 2023. They're up around 40% from that trough on a total return basis. Private valuations troughed 12 to 24 months later. Private valuations in the United States, if I'm using the Necreef Odyssey Index as an example, total returns have now increased for 6 consecutive quarters. Capital returns, so prices are bouncing around the bottom, but income returns are now more than sufficient to offset price returns that are not declining anymore. But debt is a lagging indicator. And you mentioned something, is that an opinion or is that a fact? It is a fact. You can go back to the Great Financial Crisis and CMBS delinquencies peaked 2 years after private valuations troughed. And a lot of people can say, well, Rich, you're just picking on the CMBS market. It has lower quality, blah, 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 blah. Insurance company delinquencies peaked a year after private valuations troughed, and bank delinquencies peaked a year after private valuations troughed. Why is CRE debt a lagging indicator? I like to describe it as the grieving process. It is the acceptance stage of the grieving process. Banks do not like to resolve distressed loans into a distressed market. They like to resolve distressed loans into a stabilized market, like where we are today. Borrowers also do not give up on their loans. They do not return the keys to the lender until they accept the past is not coming back. And they start recognizing that the future is different than what they were hoping for. So I think I'm going to be really direct here, the most cliche stat out there is that delinquencies hit a new all-time high. First of all, that's not true. If you go back to the Great Financial Crisis, they were remarkably higher. Multifamily delinquency rates were nearly 20%. Everyone forgets that. Pick your number, depending on how you talk to, 6, 7, 8, 9%. Who cares? They're going higher. Office delinquencies are going higher. Next month, 3 months from now, 6 months from now, delinquencies are going to be higher than that. That is a contrarian bullish indicator, believe it or not, that it's okay to begin dipping your toes back in the water.
The data really backs you up. I think, if I remember correctly, it wasn't until 2014 that we saw that peak in CMBS delinquencies, and we were still seeing loans getting resolved from 2007 as late as 2016, 17, 18. So it does make a lot of sense. A question on this same topic before we move to the next one. The types of loans that were made in the last couple of years, a lot of floating rate, a lot of value add, a lot of coming from private equity. So it's outside of CMBS, not a long track record. Any thoughts that this might be different for those types of loans than what we've seen in the past for bank loans, insurance company loans, CMBS loans?
As I said, the truth can be in the middle, and two things can be true at the same time. I do think those loans are challenged. If you bought property at the top of the market in 2020, 21, or even heading into late 2022, and by the way, your underwriting assumptions probably assume net operating income growth that didn't occur, and you finance it with short-term floating rate debt, that's sort of the mother of all squeezes. And so, it's not that those properties aren't good properties. It's that they had too much debt on them, and the debt's become really expensive because guess what? Floating rates are not where they were at nearly 0% 2 or 3, 4 years ago. So it's the mother of all squeezes. What we're seeing is those properties begin to transition into stronger hands. So, a lot of that was puppy dogs and rainbows underwriting, if I'm being very clear. But those properties are fine. They just need to transition to stronger hands at reset valuations with more realistic underwriting assumptions. They have to be worked through, but that doesn't represent the totality of the market. It's a great headline to say, oh my gosh, look at all these loans coming due, but they're a relatively small portion. And by the way, not every single one of those borrowers is going to default, even if it looks like they're going to on paper.
We've referred to that in the past as the big unforced error, the taking on a floating rate debt at market peak with really favorable assumptions in the future. It was a lot of, at best, buyer's remorse, and at worst, loss of equity, right? That's the end result of all of that. So
yeah, and look, I'm going to get maybe off topic just slightly because I want to make one quick point. This is just not a commercial real estate issue that we're dealing with. It's actually beginning to play out in the private equity market as well, where private equity did LBOs with short-term floating rate debt, and now valuations are being marked down.
That's another perfect segue to the next segment where we're going to talk about PE, risk premiums, lending discipline, and so forth. So I'm looking forward to getting into that. We saw a wonderful time to deploy money in the spring of 2023 when panic was at its peak. Silicon Valley Bank had failed due to largely, in my opinion, things that they could have controlled differently, right? This was another unforced error, but it pushed risk premiums up extraordinarily. People who deployed capital at that time saw terrific returns, but it's been a march tighter for the last 2 years. Risk premiums coming in consistently, both in CMBS and in the CRE CLO space. Are people still being compensated fairly for the risks they're taking?
Yeah, it depends upon how you think about risks. First of all, I do think CRE debt across a variety of types, whether it be CMBS, whether it be CRE CLOs, whether it be direct lending, it does look pretty attractive on an excess spread or a spread basis relative to corporate bonds, which are at, frankly, all-time tights. It's a pretty remarkable statement if you're talking about IG or high yield being at all-time tights. And I don't want to tread on that too much. But whether AAAs are mispriced, not from a risk-adjusted return perspective, we'll let the market tell us if spreads are supposed to go wider or not relative to risk-free rates. But I think as you move down the capital structure, risk is not mispriced. In fact, for all the reasons you just mentioned, delinquencies are still at all-time highs. I still think people are really skeptical about the commercial real estate market and whether we're in the early innings of recovery, if we're going to double dip. Yes, they're not cheap like they used to be. You used to be able to buy BBB minus condo bonds at 1,000 over. They're not there anymore. But they're still pricing in a fair amount of risk. Now, one of our key themes from our 2026 Global CRE Outlook, which we titled Cycle for Selectivity, is that you do have to be much more selective. So generically, I don't think things are being mispriced, but there are probably some bonds that are being traded too tight and some bonds that are not, that are being traded too wide relative to their fundamental risk. So it's becoming a much more nuanced market. And I actually think this is no longer a beta trade, it's an alpha trade.
And would you hold that same thought with regard to private equity lenders, those that are in the B-piece, mezz loan space, providing excess leverage. It seemed like at one time they were getting spreads of 500 basis points. Now it's a 200 basis point, 250 handle. Are they being rewarded, or is competition there becoming so fierce that it's something to worry about?
At Principal Asset Management, we take a 4-quadrant approach to managing real estate, public and private, equity, and debt. So I oversee research for a $100 billion portfolio across those 4 quadrants. Private CRE debt is still our number one recommendation. And the reason we like private CRE debt is if you look at how returns are being broken down, generically at the index level, if you want to call it that, you can get to annualized returns right now in the very high single digits. So call it 8% or so. And certain funds can do even better than that. Why do we like CRE debt, private CRE debt right now? Well, number one, we think risk-adjusted returns are really attractive. Underwriting standards have remained relatively conservative compared to history, and you're underwriting at a reset valuation where property valuations have already fallen generically 20 to 25%, and some valuations have fallen even more. It's going to take a very draconian scenario for those loans to take a loss. But I want to come back to 2 more points here. That does not mean every loan is not going to realize a loss. So it's 2 points here. We do think one of the really attractive points about lending on commercial real estate is you're lending on a real property. And what that means is that you can foreclose on that property if you want to, or if you need to. And you have the ability to either own the property at a valuation that allows you to sell it and not realize significant loss, or you can own it and sign leases at the right level to preserve your value. But there's a key point here. You have to be able to foreclose on a property. So we think a key portion of lending right now is the ability to actually operationally manage that property over time. You can't just be, I'm going to be a little bit flippant here, a guy, 2 guys in a Bloomberg that are lending right now because you think this is a trek to relative value. You really have to know how to have disciplined underwriting. And when push comes to shove, you have to have the ability to foreclose on the property.
Do you have some favorite operators in that space, people that have that long track record? I know PE in general, not that long, but do you have some names that you want to share that you respect highly?
Well, look, I can't talk through individual names beyond Principal Asset Management.
Right.
We have an active bridge loan lender. We have active high yield lender. We lend on the insurance company balance sheet. And by the way, we have a ton of equity across our portfolio as well. So I only use Principal Asset Management as an example of someone that can look at the various different risk spectrums, pick their spots, understand how risk should be priced. But individual names beyond Principal Asset Management, I probably shouldn't be talking through that.
Fair enough. I want to pivot to a second comment that you made earlier, the liquidity factor, how markets are so liquid right now. It's undeniable. We're seeing developers who are putting shovels in the ground having easy access to construction loans. We're seeing people that want to convert offices to hotels or multifamily able to tap the lending markets for that. Yet we've seen some real headwinds in the last 2 or 3 years. We've seen insurance rates explode. We've seen really disappointing rent growth in multifamily. We all talk about the office doldrums in many cities here. Tariffs, people were concerned that that was going to undo the U.S. economy, yet the CRE market seems to have shrugged that off at every turn in the second half of 2024 and 2025. Does that surprise you at all?
It frankly doesn't surprise me. And the reason I say that is if you look at the totality of the CRE market, I'm talking about all 18 different asset classes that fall under this broad umbrella that we speak to as a singular asset class, but it's really not. This downturn that we saw in commercial real estate valuations was not fundamentally driven. It's maybe the first time in a very long time that a downturn has not been fundamentally driven. What this was all about was repricing the right side of the balance sheet. So higher interest rates led to a reset in valuations. Long way of saying a stagflationary environment is not good for commercial real estate, and that's what we were dealing with for the past several years. What we're seeing right now is what CRE is supposed to be, which is an income-driven asset class. I think we have forgotten that over the past cycle. because from 2010 until 2020, the vast majority of total returns were driven by price returns against a backdrop of tightening cap rates. Historically, income return has been the primary driver. So I think this cycle has played out like it was supposed to, and we're now getting back to basics underwriting, where net operating income growth is going to be the primary driver. But you're bringing up a really important point here. When we talk about this cycle recovery, we call it a cycle of dispersion because there's significant dispersion across property types, markets, and even fund vehicles. The headline returns are talking about a relatively mundane recovery, but that's because of the law of averages. And the top quartile of assets are doing really well. The top quartile is already up, call it 10 to 20% from its trough. The bottom half, the bottom quartile, is not doing so well. So I think the law of averages is telling you the commercial real estate market has turned the corner, but it's going to be a slow turn and maybe look like a U shape, but it's really because of this K-shaped recovery that's emerging. So it comes back to the point that you were making previously. I think this is no longer a beta trade. I think this is an alpha trade. I think you have to be really selective about what property types and what markets you're lending in. I do think that there will be some investors and some lenders that probably don't do as well this next cycle if they're not picking the right property types in the right markets, and others will do great.
I want to pivot to property types, specific property types that have generated an awful lot of attention in the last couple of years and get your opinions on these. Let's start with multifamily. Multifamily, enormous amount of new inventory coming on, especially in the Southwest and Southeast. Flat to negative rent growth, a lot of buyer's remorse. We talked about that. People who deployed capital perhaps in 2021 or early 2022. Is the worst behind us now, or is there more to go in terms of the fundamentals, the rent growth, the NOI improvement, et cetera?
So my answer, and this is one of my favorite topics to discuss, my answer is yes and no. Let me explain what that means. You hear this stat thrown out all the time that the U.S. is underhoused by, pick your number, 5, 7, 8 million homes. Low end might be closer to 1.5, but we're underhoused to some degree. We actually think that's mathematically true, but the wrong debate. We have a housing mismatch in the United States. We have built too many houses of certain types in some markets and not enough housing in other types in other markets. I actually think we might have a long-standing conventional Class A and multifamily oversupply problem. So even though new development is coming down, it's going to take a long time to digest through that supply. And I'm sort of the view that conventional Class A rents are not going to rebound as fast as everyone thinks they are on a national basis. On the other hand, this undersupply that everyone talks about is really in the affordable housing space. It's hard to build affordable housing. I'm not sure how much we want to go there. But what's really interesting in this market, which no one's talked about, is Class B housing. Now, Class B housing isn't something that anyone really likes because you haven't been able to make money in a long time, but it might be the sweet spot, especially if you can do value-add investing. So what does that really mean? We think that this is a really unique time to be investing in multifamily or rentership housing in the United States. You need to look at housing holistically. You need to take a market by market, property by property view. And by the way, it's not about apartments. It's not about single family rentals. It's not about manufactured housing or student housing. You have to look at all of this holistically. And if you're just taking a single sector view in a specific market, I think you're going to underperform. But if you can be selective and pick your spots, you might have an opportunity to do really well. So a key theme is that two things could be true at the same time.
You talked about Class B, that might be the sweet spot. Do you have a bullish geography and a bearish geography, things that you're very positive about, things that you're very negative about?
Yeah, I like to talk to people about the revenge of the Midwest. I think people forget or maybe don't know that Chicago multifamily is one of the best performing markets in the United States. Slow and steady wins the race. We have not built housing in the Midwest in a very long time. So we're starting to see this rebirth of Midwest markets because places like Cincinnati, Columbus, Indianapolis, Chicago, Louisville, Kentucky, where my family's from, these are real markets. They haven't had the strong growth, but they haven't had the oversupply problems. So that's one. Number two, I think the coastal markets like New York and San Francisco are doing quite well. But there's another theme that is quite interesting, which is these major tertiary markets like a Greenville, South Carolina, a Huntsville, Alabama, Northwest Arkansas, Fort Walton Beach. These markets are seeing transformational economic booms, and not everyone wants to live in Nashville, Tennessee because it's become expensive. Some people want to move to Knoxville. Some people want to move to Chattanooga. I think you're going to start to see these major tertiary markets become more interesting. As I like to tell people, I'm not looking for the next Austin, Texas. I'm looking for the next Richmond, Virginia.
Turning now to office, amazingly, we've seen some incredibly upbeat headlines in office lately, limited really to New York and San Francisco. New York, the best leasing quarters in several years, maybe in a decade. San Francisco, where he's talking about the AI trade and so forth. But that seems to be masking bigger problems. Is that your opinion, or do you think that we're starting to come out of the darkness?
At the risk of being cliche and being repetitive, yes and no. So let me frame that conversation. JLL has one of my favorite statistics. 90% of vacancies in the United States are concentrated in 35% of buildings. Really remarkable what I'm saying here. We do not have an office problem in the United States. We have a Class B and C office problem. What is a Class B and C office? It's an office building built in the 1970s and 1980s that has had no CapEx put into it over the past several decades. Office is a really tough asset class. It's always been because it's very capital intensive. It requires a tremendous amount of CapEx. I think the market is still trying to figure out what is a high quality property versus a low quality property. When I think about office, I think about core office, I think value add, and I think opportunistic. We're still a little bit cautious about buying office properties in core funds that we manage, primarily because CapEx is really intensive and you don't know how much CapEx you have to spend. I would be looking to lend on office to get my core exposure. I think as you move out the risk spectrum, you're starting to be compensated to do value add plays and opportunistic plays in office, but this isn't light value add. This is like rethinking the whole office complex. So I think we're getting there. And frankly, I think the leading indicator for all of this is what's happening with the lending markets for office. It's not to suggest they're booming, but they're back to historical averages, which is a pretty remarkable statement. You can look at the SASB market in 2025 with what it was doing with office and the demand that you saw. So I think we're there. And I think if you were to ask me, will office be one of the top performing sectors over the next 10 years? I certainly think it's going to be top half. And if you really pushed me, maybe there's a chance that it might be even better than that. Last cycle's losers are rarely next cycle's losers.
Are there any property segments right now that you would underweight, that you look at and say, too many dollars chasing, too few assets, or rent growth isn't going to be there, or too much inventory coming online? Is there stuff that you don't care for right now?
Yeah, whenever I get a question asked like this, I go to the industrial sector, logistics. And I don't want to say we're underweight, but we introduced a concept of selective conviction in our 2026 outlook. I think the market still likes industrial generically way too much. And the reason I say that is everyone knows net operating income growth over the next 3 years, 4 years, 5 years is going to be pretty strong because in-place rents are below market rent. So you can push that mark to market. But if you look long term, asking rents have already normalized significantly. And there's pretty significant tiering at the same time between the top markets and the bottom markets. That's a long way of saying the best properties in the best markets still have a lot of opportunity. The middle quality properties have sort of just flatlined, and the lower quality properties have really rolled over. What we think really works in this environment is new modern logistics facilities, but that's an increasingly small subset of logistics. We think there's a chance that portfolios that have gotten very long and for right reasons, logistics over the past 10 to 15 years, now might be a good time to start relooking at those portfolios with fresh eyes and maybe pruning your portfolios.
Incredible bull market in that segment, right? Since 2015, it's been nothing but up, up, up. I've been one saying at some point this trade has to get tired, but I've been wrong for a long time. So someday I'll be correct on that front, but thus far, certainly early. How about property segments that you think are undervalued, that you think investors are not appreciating as much as they should?
Yeah, so I'm going to go with shopping centers for a second, but maybe not for the reasons that you're mentioning. I think everyone sort of likes shopping centers to various different degrees. And the reason why is pretty clear. Cap rates are wide because, or wider, should I say, because a lot of investors still have retail real estate as a redlined asset class. But fundamentals have returned to really strong footing. Vacancy rates are at near historical lows, and that's for two reasons. First, no one was dumb enough to build a retail property from 2010 to 2020 during the retail apocalypse. I'm being facetious. There was clearly retail properties built, but then COVID was a great Darwinistic event. The second thing is retailers recognized that needed physical retail real estate to satisfy micro fulfillment. So the balance of powers moved back from the landlord from the tenant. So that really means that you have wider cap rates and you have stable fundamentals. Why are we bullish on open air shopping centers? Well, there's 115,000 of them in the United States. We think the institutional cohort of that is only around 5 to 10% of that 115,000. If that's true, it might be one of the few asset classes where you can see material cap rate compression this cycle at a time that fundamentals are actually really strong. So we look at open air shopping centers. This is a really interesting asset class. I'm happy to talk about senior housing as well, a little bit nichier, but another asset class that we're quite bullish on.
Senior housing certainly on fire. We're seeing tremendous amounts of sales these days, but let's stick on retail for just one more second. One of the confounding things for me during COVID, no surprise that grocery anchored did terrifically. No surprise that department store malls, super regionals, et cetera, struggled. But I was stunned by the lack of problems that you saw in the shopping centers that were anchored by the TJ Maxx, the Marshalls, that had a Joann's, a Michaels, things like that. Did that surprise you at all? It stunned me.
It 100% surprised me at the time. But what you're finding is people really like convenience-oriented, local, quasi-discount goods. And there's not a ton of those. So they continue to drive a lot of demand. Some people describe them as power centers. Some people describe them as community centers. I don't know what they are. I think there's a blurring of lines, but this convenience-oriented, non-grocery store anchored property type is really fascinating. And I don't think enough people are looking at it for all the reasons you just mentioned.
So quickly tell us about senior housing, why the bullishness there. I
Yeah,
know it's a
sure.
little niche,
Well,
but
look,
it has been on fire.
yeah, I think everyone understands the aging demographic story. Senior housing is actually a really big asset class. There's everything from 55 plus age restricted to independent living to assisted living to memory care to skilled nursing. We like it because number one, it's private pay. The vast majority of it's private pay. What that really means is people are paying for senior housing because their retirement 401ks went up and their housing prices went up a lot, so they can pay for these out of their private pay pockets. It does not have government subsidy associated with it. That's point number one. Point number two is that cap rates are actually quite wide, even wider than retail real estate. The reason being is they are very operationally intensive, especially as you go out the care spectrum. If you know how to manage these, and that's difficult, you can make a fair amount of money on them. The third point, though, which I don't think people fully appreciate, is the expense side of the equation was pressured significantly during and after COVID because not a lot of people wanted to work in a senior housing facility. I understand that. So labor costs went up dramatically. Labor costs are just now beginning to normalize, believe it or not, 5 years on, 6 years on. So it's a fascinating asset class that we still think has strong demographic demands, strong fundamental drivers if you can operationally manage these. But you have to know how to operationally manage them. You can't look at it just as I'm going to allocate to senior housing because it's a little bit of real estate and a little bit of an operating company.
Is some of the high cap rate there, would you say, a holdover of the stigma that nursing homes got during COVID? People saying, this is a dangerous place to put my mom or dad, right? The numbers just don't look good. They're not taking care of elderly people, and that's been very slow to snap back.
That's what I sort of mean by operationally intensive. I don't think people recognize that this is an asset class where you're putting your loved ones. And so if you're not comfortable with the operations of the property and you see high vacancy rates, for instance, that's red flags. So I think it's all tied up together. Now, have people lived in their homes for longer periods of time? Yes, but I think it's really central to what you're talking about. It's operationally intensive because you're dealing with people's loved ones. And unless you understand how to treat those people and how to, keep your occupancies full without, violating any social contracts, if you will, it's a tough asset class. And if you do it well, you can do it really well. And if you don't, you can maybe not do it so well.
The CRE markets at times over the last 15 years have pulled back and pulled back hard. We saw it during the taper tantrum. We saw it during the oil bust. We saw it to some degree when Silicon Valley Bank was failing. As a last question on the market, is there something that you're watching that would concern you that you would say, this is the inflection point that I was worried about? We have been in a very, very liquid period of time. Now I'm a little bit concerned that lenders may be pulling back and we may enter a period of illiquidity.
So I'm going to give you two answers to the same question on opposite sides of the coin. The first one is a little bit more intuitive, which would be a stagflationary 2.0 environment. If inflation reared its ugly head again and the Federal Reserve started to have to maybe consider increasing interest rates and 10-year Treasury rates were closer to 5% or even above that, that would give me a lot of concern for a double dip in commercial real estate valuations. And I think lenders could start to pull back again. And lending has only recently started to loosen from a standard perspective. So a stagflationary environment. The second point, though, is I think a little counterintuitive, and it surprises me that it's counterintuitive. I hear all the time commercial real estate market participants rooting for a lower interest rate environment where the 10 years closer to 3%. I completely disagree with that. Yes, in a scenario where the Fed engineers a soft landing, maybe that's a good environment. But I generally put a 3% 10-year Treasury rate into a bucket of be careful what you wish for. If we're in a 3% 10-year Treasury market, it probably means something not so great has happened in the economy. Growth is slowing. And by the way, lending conditions are tightening. So we're not rooting for falling 10-year Treasury rates 100 basis points lower than where they are right now. What we're rooting for is stability in 10-year Treasury rates. If the 10-year Treasury can remain in this 4 to 4.25 range, then the market can go back to underwriting commercial real estate, which is the way it's supposed to be, which is based upon net operating income growth, how much CapEx you have to spend, and the availability of debt capital. So I tell people really be actually watching closely from a contrarian negative signal if the 10-year Treasury rate starts moving significantly lower, because that's maybe not the bullish signal that you're thinking.
These have been some great insights, Richard. I really appreciate you joining us today, but I want to go back to something. We usually end up with a slice of life. I want to go back to something you said at the top of the hour, your family managing malls around the East Coast. So take me back to those early days when you were first allowed to run around a mall without supervision. Was it the arcade? Was it the sporting goods store? Was it the food court? Where would the young Richard Hill run to first when his father said, Richard, just go wander around, be back in 45 minutes?
Oh my gosh, this is really easy.
Or what is your favorite retailer, your favorite legacy retailer? Either one of those would be right.
This is very, 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 very easy for me. There's two favorite legacy retailers, Eckerd Drugs and Sears. For different reasons. I don't think people actually remember Eckerd Drugs having these old school soda shop where you used to be able to sit in front of it. I grew up in Charlotte. I grew up going to a mall by the name of South Park Mall, which is one of the major retail REITs, premier malls. But at the time it wasn't. So I had to go to Eckerd Mall and get as many crappy things of candy, that's a technical term, as I possibly could. Or I would run to Sears. And I vividly remember Sears having, when Nintendo just came out, Sears having one of these Nintendo displays. I just thought that was the most amazing thing in the entire world. As I got older, it was the record store. I vividly remember getting my first Pearl Jam CD in a mall, had my first kiss in a mall. So pretty cool place.
There you go. I'll take the other side of the coin on the Sears, largely because of that annual trip to the Sears photography office with the plaid leisure suit and my father licking his palm to mat down my cowlick because I didn't comb my hair in the morning. So that's my other side of the coin, Sears. Richard, I got to thank you so much for coming. We covered so much ground in 40 minutes. I love your insights. You always come so loaded with data and perspectives. I hope we have you back sometime in the next 6 months or a year. Really entertaining and informative conversation for me.
Thanks for having me, guys.
And that's a wrap on this week's episode of the CRE Weekly Digest. Thank you for joining us today, Richard, and thank you to our production team at Bruning Media. Please join us every week as the Lightbox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.